Hey everyone, welcome to yet another episode of Punch Card Investing. I'm back for this week. Sorry for ditching you guys last week. Though I was sure to smash the like button, as you guys should be sure to smash the like button this week too. Now that I'm here, you got no excuse. If I was the reason you didn't click that like button, now you can. Though I won't give myself too much credit there since we're always putting out that high quality value investing content. But this week, on the theme of value investing, and seeing as though we just had the Berkshire annual meeting, we wanted to talk about Warren Buffett's top investments, or at least our favorite investments. Not necessarily the best returns necessarily, but they're all going to be pretty decent returns since he has such a great track record to cherry pick from. So that's the topic we're going off of today. And we're going to try going through chronologically some of these investments to highlight. One that we will not be talking about in this show will be the Coca-Cola investment. That one's been covered so much anyways. Tom did a detailed breakdown not too long ago, I know. So we won't be doing Coke, but there's plenty others to choose from. So go ahead and kick it off with Brad. He wanted to go first.
Okay, so I'm going to be digging into American Express. I want to ask two questions first for all of you. How many of you have used American Express traveler's checks? None of you. You're all too young for that. How about an American Express credit card?
No, but my girlfriend has one.
Not yet.
There you go. All right. Well, American Express has more brand building to do, apparently. So it's 1963, right? American Express is one of the most powerful brands in the world at the time. The most trusted financial services company in America, for sure. It had been around for almost 100 years, and traveler's checks business was an absolute juggernaut. It was an incredible business. And the idea there is before you traveled, you would go to your local American Express office, give them cash, and they would give you traveler's checks, which were guaranteed paper for that amount backed by American Express. So that way when you travel, you exchange those traveler's checks for cash in the local currency. We didn't have these global networks of ATMs back then. So it was an easy way to carry essentially cash, but without the pitfalls of carrying a bunch of cash when you travel. Now, what happened in 1963, American Express had a small subsidiary operating warehouses and issuing receipts for the commodities in those warehouses. So, for example, you'd have a warehouse full of salad oil, in this case, soybean oil, and you would get American Express to come in. They would inspect the product and issue paper that says there are XYZ tons of soybean oil in this warehouse. Then you can take that paper and collateralize it, borrow against it, trade against it. You're financializing the product that's being stored in the warehouse. Now, this business was much smaller than their consumer business, their traveler's checks business. And, it was all working fantastically until a guy named Anthony Tino DeAngelis from New Jersey decides he's going to pull one over on American Express. Okay. He decides to fill his tanks with seawater while claiming that they were tanks of soybean oil. Now, when they would come in and test these tanks, it sounds like they would only test kind of the top couple inches. And of course, if you put seawater in a tank, the oil is going to rise to the top. So you can, pretty easily pull one over if they're not dipping their implement deep enough into those tanks. So he used these funds from American Express essentially to gamble. Right. And he had quite a scheme going on. That's a whole separate talk that you guys can dig into. But effectively, he gambled with the money. He lost it all. And so the creditors, of course, he's not able to pay them back. So they come after these tanks in the warehouse of soybean oil. And of course, they discover, well, it's not soybean oil in the tanks. It's seawater. So in the end, it worked out to about $150 million worth of fraud, which is, I don't even know what that would be in today's dollars, but it was a massive operation that this guy was running. So of course, Amex is on the hook, right? Because supposedly they verified that there was salad oil in these warehouses. So of course, this rocks the stock of American Express. It dropped over 50% once the news broke that this was happening with one of American Express's subsidiaries. And there were a bunch of analysts that predicted that the company wouldn't survive this. So Buffett looks at this and thinks, well, how true is this? That Amex is in danger of going bust because of this. So what he did, he hired people to go around Omaha and New York City interviewing customers of American Express about what they thought of the business. Have you heard about this salad oil scandal? Are you still using traveler's checks? Are you using the credit card? He wanted to get a sense, is this actually tarnishing the brand? Or, are analysts kind of working it up? So he figured Amex can easily absorb all the losses just with the cash that they had on hand. They had $200 million in cash on the balance sheet. And, like I said, this was around 150 million of fraud. They also had over 500 million in float from the traveler's checks business. Okay, that was a big part of what drew Buffett to American Express in the first place. You collect cash up front for these traveler's checks, and you don't have to pay that out often for many months, sometimes never. So it was similar in a lot of ways to an insurance business in that way. So Buffett made a huge bet on American Express because he thought, the situation with the stock crashing more than 50% was totally overblown. At the time in 1963, Buffett partnership had 17 million in capital. Buffett put 3 million right away into American Express. That was like his first entry bet with Amex. He eventually put 13 million into American Express and owned 5% of the company. That was a 40% bet at the time, 40% into American Express. And of course, the next year, American Express settled the case for 60 million. So it was originally thought it might be 150 million. They talked it down to 60 million, and the stock went through the roof. So Buffett made 2.5 times his investment over the next 3 to 4 years. So on 13 million, he made 2.5x. The big mistake that Buffett made, though, is he sold it all once he made 2.5 times. So, of course, I think it was like 1994 that he got back in and bought like 10% of the business in 1994. So if he had simply held that original 5% stake, that would have worked out a lot better for Buffett. But, the nice thing is he really understood the business. He followed the business over those decades since he originally bought it. And it's done well for Berkshire Hathaway since. So yeah, that's American Express.
Do you know out of curiosity, what the return compounded over that time period was? I'm curious what kind of error it was.
Yeah, I looked at what would it have cost in 94 to buy 5% of the business versus what he paid in 1963. And it would have been like a 13 or 14% compounded rate of return over 30 years. So,
oh, wow.
Yeah.
I'm trying to wrap my head around that, the size of that fraud. $150 million then. I did a quick inflation calculator. It's well over $1 billion. It's just in today's dollars. It's just nuts to think about a fraud of that scale. I guess we had plenty of it in 08, which was be the source of another deal soon. But
yeah.
So how much was the business worth? How much was American Express worth at the time?
Well, let's see. He put 13 million in for 5%. So 13 times 20. What is that? 260 million, say.
Yeah.
And it's worth over 100 billion today, I think.
100 billion.
And the
Yeah.
fraud at the time was worth almost the entire company then. So like that'd be
Which is
crazy.
why people were
Yeah, no
pretty
wonder the
freaked out
stock
about it.
popped when that was
Yeah.
cut in half. It's like, oh, you got a quarter of the business back, basically. That wasn't
Yep.
going to be liquidated.
Yep.
Yeah, I wonder if one of the concerns was that there could have been more of this fraud, like whether this wasn't the only one.
Mhm.
Because that's
Who
a
knows?
pretty absurd fraud. Like,
Yeah.
putting seawater in, like, wow. That's just, it's not even like accidental, like, oh, we just did some accounting magic. Like, no, it's just straight up, like,
Straight up.
robbery.
Yeah.
Nuts.
I think Buffett at the time also was a lot more willing to turn over his positions, not compared to today where he's looking
Yes.
for long-term
Very
compounders.
true.
So he probably made that 2.5x in that short time period and was happy to get out, I guess.
Yeah, that was his model at the time.
Yeah.
The
And he
cigar butt
would've-
kind of model.
And he would have done far more than 15% a year or whatever Amex did in other investments.
Right. Yeah, so maybe it wasn't a huge mistake.
Mm.
Be
He had
curious
to
to
work
hear
a
his
lot harder
take
for
on
it, though.
What's that?
He had to work a lot harder for that extra return, though, than just holding Amex.
Yeah, and there's the whole idea of being able to work with the float, which obviously he didn't own the business outright. So, but that's something he was piecing together even back in the early '60s. Is how do I find synergies between different investments where I get all of this cash flow over here and float, and just a puzzle that he's putting together so early in his career. Pretty impressive.
Hey guys, before we switch to the next one, Luis says he bought his own shameless cloners mug. So shout out here.
Shout out, Luis.
We have these guys in the description, designed by our very own Karangernani, with the Monish mustache on the Dolly the sheep to signify our shameless cloners. Fantastic product, if I do say so myself.
Yeah, shout out, Luis. He actually sent me a signed Phil Town book a couple of years ago as well. So shout out to
Luis
Luis.
is the man.
Cool.
He is.
All right, who's next? I think we got Tom, if we're going chronologically.
Yeah, I will share my screen.
I like Tom's one. This is good.
I don't know if I'm quite as well researched as Brad, but we'll see.
I was thinking that.
Brad,
I was thinking that.
that was like a
Well,
sit around the
Karan gave
fireplace.
me a shortcut. There was a podcast that basically went through it. I was like, okay, good.
It was
Did you
almost
just
like
find a transcript and read that off, Brad?
No, not quite
an
that
audiobook.
bad. Not
a
quite
history
that
of American Express? Like,
bad.
all right, Tom, here you go.
Cool. Are you guys? So my screen's up. You guys can see that.
Yes, sir.
Okay, perfect. Cool. So, See's Candy is my my investment or acquisition that I want to talk about from Buffett. So, See's Candy is interesting because it was sort of the first famous example of when Buffett invested in a business that wasn't one of these cigar butts, and it was probably such a successful investment that it sort of led to the Coca-Cola investments and other investments that he's had that are very famous and very well-known companies. So I pulled a screenshot from the 1984 Berkshire Hathaway annual report because I just wanted to show some of the growth that See's Candy's experienced and kind of a few of the things that maybe influenced Buffett to then go on and buy into stocks like Coca-Cola. So hopefully you guys can see the numbers in here okay.
If you zoom in a little bit, Tom, that'd make it a little bit easier.
Is that better?
Yeah, that's a lot better.
Perfect. Yeah. So, so if you can't quite make out some of those numbers, basically See's Candy went from about $31 million in revenue in 1972 to $135 million in revenue in 1984. So, crazy growth. And I think one of the even more interesting parts of that is if you look at the number of pounds of candy sold and the number of stores open, neither of those things grew anywhere near as fast as the sales revenue. So, this is an example of a business that was basically able to keep putting prices up. They had a lot of pricing power through sort of in general, but also through a relatively high inflation period, particularly towards the 80s. So again, that's an example of something Buffett talks about a lot with his investment in things like Coca-Cola as well, that they have pricing power.
They rode that late 70s inflation like seamlessly. So very nice.
Yeah. Yeah, for sure. So the other thing I want to do, I guess, for a lot of us, when we go and value businesses, a lot of us are going through and making things like discounted cash flow models. So any time that we do a discounted cash flow, it's sort of us attempting to predict the future in terms of what we think Seas Candy or any business that we might be looking at. Unfortunately, Seas Candy is not a public company anymore, but we're trying to predict the future of what sort of cash flows the business can generate and then trying to sort of value it from there. So, one of the cool things that we can do with this example is we know what the future cash flows were for the 10 years after Buffett bought it. So I thought I'd plug in sort of the actual performance of Seas Candy and then see how good a deal I think Buffett basically got when he made this investment. So if I jump over to this tab, hopefully you guys can see that. So I've basically just copy and pasted the after-tax operating profit from that 1984 annual report screenshot into this column and have basically run a discounted cash flow on this. I've used a slightly higher discount rate than I typically would, again, because as I've put in a note here, 10-year T-bills were a lot higher than they are today. But nonetheless, if we run through this, we basically get a present value of future cash flows of around $63 million. And the price that Buffett paid was $25 million. So he got a deal as far as I can tell.
Yeah, for real.
Yeah. So I'm coming out at a 60% discount to intrinsic value. Of course, at that time, you're obviously betting on pretty substantial growth for Seas Candy if you did stump up with the 62 million, and Buffett perhaps wasn't so comfortable doing that. But in hindsight, it was a fantastic deal.
Do you know what the growth rate is on that after tax? Have you the operating profit?
Great question. I would have to do the maths on that. I don't know.
It must be pretty high. Yeah. It's about a 5x. I think it's about 18% roughly, because it's a 5x over 10 years roughly. So around that mass, I think it's about right.
Yeah, rule of 72. There you go. I'll take your word for it on that one. That sounds about right there. That sounds about right. So yeah, that's the Seas Candy investment. There's just one other bit of info I wanted to show, which is kind of more around that pricing power again. So I've actually gone down and again taken that same information and tried to figure out what was the price per pound that Seas Candy were able to charge, which is in this column here. And they were able to crank that from $1.85 a pound to $5.50 almost per pound over that 10-year period. So pretty crazy price increases. It's actually not as significant as you might first think. So this is the annual price change in this column. So in some years they were bumping it, 15% a year, or even 17% in 1974. But this was also a period of time where they had really high inflation. So the year that they bumped the price 17%, they had 12% inflation. But it just shows the power of, being able to push up prices in these really good businesses. And in this final column, I've got basically how much either side of inflation they were able to push those prices up, which in most years they're about equal to it or a fraction ahead.
Do you know if Seas had any significant debt? As I'm sure they have all their stores, so there's like a capital investment up front, and that's going to be it's like adding leverage to the inflation situation. Do you know if they have a lot of debt?
I don't know for sure. My guess would be that they've got very little, because I've heard Buffett talk a lot about how Seas Candy is a very capital light business that produces very high returns on capital. So I'm just going to interpret that statement as Seas didn't need a lot of money to kind of get to the scale. And they've tried to grow it in the past. Buffett has talked a lot about trying to open stores in new states and new cities, and it just wasn't all that successful. They've kind of capped out the growth that they can get. So I don't know for sure, but my guess would be it had basically no debt on it.
And I'd probably assume that, just because I know borrowing was not nearly as easy as it is now. Like the rate you're getting on a business loan then was not nearly as low as today, not even close. So especially if T-bills were netting like 6 to 7%, So pricing. Let's see. Let me get our faces. There we go. Like pricing power, that is a great example of like how important having some pricing power built in is, especially in a time where that was kind of where central banks around the world were unlocked. So having that built in protected Seas Candy from being eroded away with inflation. So
I'm glad you showed that.
Are a good solution.
I'm glad you showed that last table, Tom. It wasn't it wasn't necessarily in the volume that they were selling, right? Those incredible numbers. It was their ability to raise prices was such a majority of that.
Yeah, I think that I'm not sure if I've still got the numbers in front of me, but the price, the volume growth was like 50% over 10 years, but the operating profit was a 10x or so. So
yeah. All right.
Awesome.
Should we move on to the next one?
Yeah,
What'd you say, Karan?
What was the price that Buffett was willing to walk away from the deal? It was like 50,000 above or something, right?
Yeah, I do remember him saying that. I don't know the figure off the top of my head, but I remember him talking about how the negotiations got very tight, and he'd sort of given his final price, and it, wouldn't have paid very much more than the 25 million, which would have been a huge mistake in hindsight.
I wonder if Charlie would have talked him into it.
Yeah, Charlie was actually okay with paying, I think, up to 30 or something, 30 million for the business. He was like, sure, we can pay that much, we'll make it back. Yeah, I think that's when they really were so different in their approach. Focus on cigar butts, focus on compounders.
Yeah.
They came together over chocolate.
They did.
Sure.
Chocolate and Coke.
Should we move on to Frank then?
Yeah, let's do it. So mine that I'm looking at is kind of a strange reason why I chose it. It's not the return on investment per se, but how it eventually affect Buffett as a manager of Berkshire Hathaway. So I'm looking at the Capital Cities investment, which was 1985, and he invested $535 million into the company, which gave him a 20% stake. Or I've heard ranging reports. I heard one 16% and one 25%, but they were merging with ABC at the time. So I gave a rough answer, about 20% stake in the company. Capital Cities, if you don't know, is a media conglomerate run by CEO Tom Murphy. And Tom Murphy is the main reason why I chose this. So as much as a great investment by Buffett, it's also great execution by Tom Murphy, who later eventually ended up on the board of Berkshire as well. And he was written about in the book Outsiders, which I've plugged a few times, by William Thorndike, where it talks about 8 of the best CEOs of all time, Tom Murphy being one of those. So it was the biggest, when they were merging with ABC, the Capital Cities and ABC merger was the biggest deal, non-oil deal of the time. So it was about a $3.5 billion deal approximately. And Buffett obviously funded around $500 million or $535 million of that deal. The return on the investment over a 10-year time period that he held it was a 5x, which I think is about 18%. And when he eventually cashed out, they sold it to Disney, and Buffett got $1.2 billion back in cash and $1.3 billion in Disney shares. So it eventually turned out to be a good investment by ending up in Disney. But overall, I just like it because of Tom Murphy, nonetheless, who Buffett said is the biggest effect on his management strategy. And that's why he runs that decentralized approach to Berkshire Hathaway, where he kind of just lets the managers of these businesses that he acquires to just do their thing. There's no real top-down approach, decentralized management, which he has completely accredited to Tom Murphy. And I think that's a big part of the reason why Berkshire's returns over, since that time period essentially have been so great, I think can be somewhat accredited to Tom Murphy. And it's a big reason why he is part of the board now. So the return is great as well. Like, you can't complain with a 5x over 10 years, 18% compounded. But mostly I just think it's that partnership between two of the best CEOs of all time. And that's about all I've got.
I think that's around the time when Buffett was a lot more public, right? I think people finally got to know who Buffett was during that deal, was it? Or...
Yeah, well, I think he's just starting to reach that point. I actually read the 1985 write-up in the Washington Post. So it was publicized in media. And because it was such a big deal, that kind of brought a lot of attention to both him and Tom Murphy, I guess.
It'd be interesting to chart the attendance of the Berkshire Hathaway annual meetings over the years. probably see some kind of inflection point in there. I wonder if that's when it was.
Yeah. Do you think the CAGR on audience numbers is as high as his investment returns, or?
Great question. Probably not.
I bet it's like probably exactly correlated to the actual the stock price. I bet. I can't say for certain, obviously. If you take out these last virtual years, now they're probably like 10x what they were before. This is all virtual attendance, right?
Yeah.
So
that'd be an interesting study to do, actually.
yeah. Content idea.
Yeah, there you go.
Not very helpful, but fun.
Yeah, fun. And then moving forward, I guess, if they keep doing buybacks, you've got to figure out whether it's more closely correlated with the share price or the market cap. That's right. Kind of stage 2 of the analysis.
Layers.
Yeah.
Should we move on to Karan then?
Sure.
Let's do it.
Right. So the investment that I want to talk about was the 2008 Goldman Sachs investment. And the reason for this is, I think, because Buffett's investment kind of not only was a vote of confidence in the state of the American economy and the financial system, but, it kind of overall started more people investing into the companies. So I think to get the idea about the significance of the investment, the timing of the sequence of events is very important, because that'll show you how conservative he was when structuring this entire deal. So the crisis started well before 2008. I think we've all seen The Big Short, right? So
many times.
The Big Short, yeah. So Burry started predicting it in 2006, I think, or 7, and there were other investors who were in it. But the real fear in the market started, I think, when Lehman Brothers collapsed on September 15, 2008. And that is when people started doubting the stability of everything, right? So it was at that point that the Fed realized that they have to come in, they have to step in and stabilize the system. So September 15th was when Lehman Brothers collapsed. September 21st, 6 days later, they got Morgan Stanley and Goldman Sachs to change their entire company structure from being a financial services company to a bank holding company. And the reason for that was so that once they become a bank holding company, once they're recognized as a bank, the Fed essentially backs them, right? So any losses, everything are backstopped by the Fed. Also, they can raise deposits, that are FDIC insured. So 15th, the crisis starts. In a way, the fear starts. 21st is when Goldman changes their structure. 23rd September is when Buffett first invests into Goldman Sachs. So only once it was completely certain that Goldman is not going bust, he put in $5 billion and brought preferred shares yielding 10%. Right. So the structure that he had overall was he put $5 billion in for the 10% preferreds, plus he got a warrant on top that lets him buy an additional $5 billion in Goldman common stock at around $115 per share. So the reason that this deal happened, and it was a great sign for Goldman. So the first thing that they did the very next day, on 24th of September 2008, was that they decided to sell equity and raise cash. So they raised around $5.7 billion, and that was for around $123 per share. And which really, was terrible for the people who actually bought into this, because in a month and a half, the stock was down to around 60, 65. So anyone who bought into this new equity offering kind of got screwed over pretty much. They lost 50% in a month and a half. But Berkshire Hathaway shareholders didn't suffer at all, because they were holding the preferreds that paid them around $500 million annually. And he completely just protected the Berkshire shareholders, got the best possible deal, structured everything in the best way possible. And that deal has been copied again with the Bank of America deal. It was copied last year with the Airlines Bailout, where the government said we want warrants on the companies, on the airlines. So clearly, I think just showing you how conservative that entire deal was, that no matter what happened to the stock, Berkshire is going to make money. That structure, the downside protection, I think that is incredible, the way he structured it.
When did the warrants expire? How many years did he have to exercise those?
I think it was 10 years, but he exercised them in 2013. Yeah, so the
So
warrants actually gave him 43 million shares. But he worked out a deal with Goldman where he got 2 billion in cash and then I think around 19 billion or 13 million, in stock.
It's kind of when Berkshire, I always kind of, they almost like switched into becoming like a bank, that almost like a bailout machine if they really want to, because they have so much cash that the float from the insurance business and all the cash they've accrued it gives them so much flexibility to do those sorts of deals. And go ahead, Karan.
Yeah, he sold out of the Goldman investment last year in 2020, and out of JP Morgan, Goldman, everyone. So
except
everyone
for Bank of America. Yeah, that's the only one. And he doubled down on that fairly recently. I don't know if he added in 2021 or 2020, but I know he added in the last few years.
Yeah, he did add in 2020 at $25-ish a share, I think.
Yeah. Well, I guess we could talk about Goldman, and then I was going to talk about Bank of America, since they are very similar in how they're structured. Just Bank of America took place a couple of years after the fact. Same sort of deal, except that it wasn't in the midst of the crisis. It was more the aftermath. As in 2011, apparently in the bathtub, Warren Buffett says he had this epiphany that, hey, I should offer all this like $5 billion in cash or something like that to Bank of America. The CEO at the time said, no, we don't really need the cash right now. But he said, yeah, it's not that you need the cash, but you could use it in a sort of same way with Goldman. It's like a vote of confidence. It'll help your brand. You have our backing. It's more of a signal to everyone else that you have Berkshire support and all this new liquidity. So they said, okay, sure. But so he got $5 billion in preferred shares, paying a 5% dividend. And then on top of that, he also got warrants for, I forget how much exactly, but many millions of shares at $7 or so. And for reference, Bank of America is now worth $41 a share. So, and he exercised those in 2017 at a price of around, in the mid 20s or so. So just on the warrants alone, which is almost like a freebie for giving them the cash, and that's not even including all the dividends, multiplied his money a few times over very quickly. And I think that and the Goldman deal, we've talked a couple of times on this show about cash. Is cash trash? The importance of liquidity, all that stuff. This is where people with cash make their living. It's in times of crisis like that, when they can come in, swoop in, basically acting like a bailout machine, and can get those super sweet deals, like getting a bunch of warrants to buy stock at super low prices, or getting preferred shares where you get a hefty dividend in front of everyone else. That's where a lot of bigger time investors especially make their mark. It's in times of crisis when they have the cash. And if they were only relying on debt, for example, or lines of credit, those can get locked up. Your lenders can go bust, as happened in a few cases in 2008. So having that cash is it's one of the things you can't truly replace. The risk obviously is inflation and monetary policy, but there's definitely value in having that dry powder ready to go.
Do you guys think they'll be able to do these deals in future? I mean, they were you'd think they were hoping to do some of these in March 2020, but the Fed kind of started just buying everything and got in their way. Do you think these opportunities will come up again?
I don't think
there's always going to be opportunities.
There will be I just don't think they will be like Goldman and Bank of America in that style. I think it might be more like a See's Candy type thing, where maybe you have a business that has pricing power. The way I'm thinking of it is, it seems like the next decade or so might look a lot like the 70s in the US, with pretty high inflation. And in that environment, companies with a good amount of debt, a fixed rate debt that is, and with pricing power, those are the ones that are going to come out on top, or companies that have a lot of hard assets as well. So that might be where the opportunity might lie in a time of crisis, when a company might need liquidity, even though it's in an inflationary environment, they just don't have the cash. That's where they can swoop in and then ride that inflation wave. That's what I'm thinking, where the next bigger opportunity could be. But of course, Berkshire has so much negotiating leverage that they could come up with a deal that none of us could ever think of because they just have so much cash.
Not
I
yet.
think.
Yeah, yes, not yet,
I
Brad.
think 2008 showed more about Buffett's personality than anything, like how he's actually willing to be greedy when others are fearful. Like, he keeps saying it, but he actually did it in 2008.
And
Because I
beyond.
remember 2008, like the impact even in the UAE of what happened in America was very, obvious. Like you could tell there was fear, people were losing jobs. Yeah, so
It was called the
it was
global
a tough
financial
time.
crisis, after all.
Yeah.
You had so much debt. You had so much debt that was just destroyed immediately, basically, and someone had to make up for it somewhere. And when the chips fell, a lot of people came out in a much better place. A lot of people are in a much worse place. And because he had all that liquidity ready to go, Berkshire and Buffett definitely made it out very strong. Much stronger, I would say, than before the crisis.
There was also something else that he did in 2008, which was so I just read this somewhere that he called Hank Paulson and told him, rather than buying up the mortgage-backed securities, the distressed assets, using the TARP loans, the Troubled Asset Relief Program loans, they should be putting the money to recapitalize the banks and the other financial institutions. So that's when they started actually changing the structure of the company so they could directly just inject liquidity to the banks. So I think just having that switch saved the government a lot of money, because if they kept just buying out the mortgage-backed securities and the other distressed assets, they would have been worthless. That would have just been money going to waste, pretty much.
That's kind of what's happening right now with mortgage-backed securities. I think the Fed owns half of all commercial mortgage-backed securities, which is just insane. Half the entire market of commercial real estate debt is owned by the Fed now, and they're continuing to buy many billions more every single month, which is just like, as Ray Dalio says, the markets are no longer free. They are not free. So you got to operate in this strange environment. And it's not just the Fed doing that. Banks around the world are getting central banks around the world are very active. And Luis, back at it again. Howard Marks recently expressed his dissatisfaction at companies being bailed out due to lack of opportunities missed for prepared investors. That's very true. It's just kind of kicking the can down the road, and the people who would have been prepared to take advantage of those opportunities that come with distressed deals, the deals are no longer distressed. They've been flooded with new money from the government, or the central banks. So it's a double-edged sword.
Buffett actually got a bit of heat about that back with buying the banks in 2008, didn't he? A bit of
I wouldn't be
media.
surprised.
Yeah. Because I think it was Bill Brewster on the Value After Hours podcast, talking about how maybe it was why he was a bit more quiet about the airlines this time, is because he caught that flack last time with the banks and the bailouts they received.
Sure. Yeah. It's also easy to antagonize someone with that amount of like financial power that they can essentially underwrite an entire bank. Like that's pretty humongous, and it's very rare and uncomfortable for a lot of people. I mean, it's kind of mind-boggling to think of how much power a person or one company can have.
Yeah, well, he actually mentioned at the recent annual shareholder meeting that was one of the reasons why he sold the airlines, right? He didn't like the look of Berkshire being this big, rich shareholder of an airline and then receiving government bailouts.
Well, he thought they might not get bailed out too, right? I thought that's what he said. They're less likely to get help if he's one of the large shareholders.
Yeah, true. And his investment thesis fell over, so he was out of there.
I'm honestly surprised the airlines got bailed out. I thought they would just get privatized.
Well, they did. It's not that they didn't get anything. It's more so that the lockdowns just lasted for so long. I think that's what people didn't really expect. It just kind of dragged out really slowly. Because they got plenty of loan money from the government that essentially turns into a grant. So they definitely got some sorts of bailouts, but maybe not to the level that some people might have expected. If you guys have questions in the chat, now that we've talked about all these great Buffett investments, maybe any we missed that you guys want to hear about, or anything completely different outside of Warren Buffett's world. We're all living in it, of course.
You know, the thing Lewis said reminded me, I think it was Sam Zell who said, capitalism without bankruptcy is like Christianity without hell.
Yeah, kind of.
Love it.
That's a very Sam Zell way to put it.
Yeah.
It's like privatize the gain, socialize the losses. That's been the theme of the last maybe many decades, definitely the last decade for sure. I guess we're over a decade now since 08. It's like you don't get that creative destruction when you don't let a business fail. And instead, you just let the failing business continue to exist, and then you don't get any progress because
Right.
the failing, inefficient business just keeps going in perpetuity, and that's no good for everyone except for that failing business and interested shareholders or lobbyists or whoever. So you need that. It's a necessary evil, if you can call it that, of a capitalist society. You got to have businesses kind of eat each other, and then the best one with the best products and the thing that everyone wants will be the one on top. But if you just keep throwing Federal Reserve dollars at it, that's not really helping people long term. It'll help in the short term, sure, you don't go through that pain, but then the long term pain is probably a lot worse because you miss out on so much innovation.
Yeah, and I think it makes a lot of those businesses even more fragile in future because none of them ever bother paying down all this debt they have and prepare for these crazy situations. They're kind of skating on thin ice in good times, and when something crazy does happen, it's kind of game over unless they get some help.
I saw a meme a while back, right as the pandemic was kind of starting. There were all these surveys in the U.S. It's like the average American couldn't cover a $500 emergency expense or something like that. Something really shocking. And then at the same time, companies ran out of money in like 2 weeks once the lockdown started, and then they were crying for money from the government. And it's like, who invented this like pay-as-you-go system with no savings or anything like that? And it's
Right.
When interest rates are so low, you're not really enticed to save. You're enticed to borrow and do share buybacks with that borrowed money. So it's like, no one has any savings. It's a very, very odd system, to say the least.
Yeah.
Different sets of rules for different sets of people.
That's right. Here's a question. What do you think about activists investing in smaller companies, I guess, as opposed to bigger ones? We were just talking about very large deals from a large player. But I think by activists, you mean changing the company fundamentally in some way, maybe changing the board or changing the company in some way like that. Anyone want to take that one?
I'll have a little stab at it. One thing, I follow Connor Haley from AltaFox Capital pretty closely. He's a microcap investor that wasn't kind of striving out to be an activist investor, but there's 2 recent positions where he needed to do it. When you're in these illiquid positions, and obviously for us, we will never be activist investors, but he has a large stake in these businesses. So I know Collectors Universe, I think, was one of the more recent ones. He had about a 20% or so position, I believe. And he went activist on that position, and I don't know the finer details of it. I know there was a management or a board of directors that really didn't want to do anything at all. They were just sitting there letting cash burn and really just not doing anything to activate value. And he eventually stepped in, and the returns they saw after his activism were huge. So again, I don't know the finer details, but I know it played out. It's obviously more important in these smaller illiquid positions. More can be done if you are an activist shareholder,
Right?
or you have to have a lot of money. And there's some hedge funds that kind of do that, like Elliott Capital, for example, and Silver Lake. They're the ones that stepped in on Twitter. But yeah, if I'm invested in a small micro cap and there is some activist investor that I'm aligned with, that would be a great sign in an investment.
And Karan and I are invested in Pershing Square, which obviously is much larger companies, but they're deemed an activist investor. Bill Ackman runs the fund. And I don't understand the sort of the antagonism that a lot of people have towards activist investing, because all I see it as is someone with maybe business savvy or business connections comes in and makes a change to the business, and as long as they do a decent job, they make a good change. And it's kind of like part of that creative destruction as well. Like, why are you going to if there's something glaring that you could change and add value to, why wouldn't you do it? Even if it means in the short term, like, oh no, shareholders are going to lose something for 5 minutes, but then 10 minutes later, they're going to get a lot more value. Why wouldn't you do that? So it's obviously the hard part's actually making the correct change. That's the hard part, but that's with any business. So I don't get why it gets such a bad rap.
I think it does get a bad rap from perhaps activists that maybe have really short time horizons. The people that come in and say, "Let's do some levered buybacks and crazy strategies." Sure. But someone like Bill Ackman or even Carl Icahn has held companies for 5 or 10 years that they've been activists, and they've been long-term shareholders where there's people that own the company coming in to be activists. They're not just random people who don't like what you're doing, right? So I think it gets a bad rap, but like Frank mentioned, the incentives have to be aligned, and I think he mentioned that you'd only go in with an activist if they were aligned with your strategy and your philosophy. One of the other things, I mean, I obviously don't have firsthand experience being an activist investor in a company, but one of the things I've heard of, one day. Well, one of the things I've heard of, one of the things I've heard a few people mention, particularly being activists in smaller companies, is a lot of these people are sort of founders, and they don't necessarily have a lot of experience in capital markets or as CEOs of public companies and so on. And oftentimes it's not what you would first think of as activism, where they're going into the business. They're often going in and talking to these CEOs and explaining, your stock is really undervalued, and if you do share buybacks, that's going to be quite beneficial for the share price and for investors. And they just hadn't even had these thoughts run through their head a lot of times, because they're not multi-billion-dollar companies that have 100 analysts, looking at them at all times. So I think that can be a pretty interesting situation as well.
Yeah, financial savvy is valuable in many cases, or I don't see why it wouldn't be valuable, unless you're getting into that fraud sort of sphere, like you're kind of mentioning, the guys coming in to gut the company as opposed to actually change it for the better.
Tom, I'm sure. Yeah, go ahead, Karan.
Even Seritage is the reason of activism, right? We have the spin-off because of activism. Even Equity Commonwealth, activism. So the inflection point only happens when someone gets in there and makes the change. So
since you brought up Equity Commonwealth, Karan, I've done 2 videos on it this week. That's Sam Zell's REIT, and Brad asked a question to our group already. What's been happening in Equity Commonwealth? Thanks, Brad, for that softball. Karan and I are also shareholders of this, since we have the same portfolio, apparently. That's Sam Zell's REIT. It has a ton of cash, $3 billion in cash, and then 4 office properties. They just recently announced a couple days ago that they're going to be merging with Monmouth Real Estate, which is an industrial REIT, fully occupied, 99% rent collection. So not the sort of distressed deal that you would have expected from a guy like Sam Zell. And I think shareholders didn't expect it either. He's made his bread and butter through his career on finding distressed assets or somehow creating value out of a not so great situation, but he's buying himself into an amazing situation, which you're paying a premium for. So it's a little bit strange given what people might have expected, but he's preserved his cash pile in the meantime, since he did an all stock transaction to actually take over the portfolio. So I think this is more of like a starter deal for what he's trying to do for the future. He just now has this foundation of the portfolio. Maybe he'll sell off some of the nicer assets in that portfolio, but he still has that cash ready to go. So when he does find a distressed deal sometime, maybe in the next couple of years, if that happens, he'll still have that dry powder, as he calls it, ready to go. Karan, I haven't really heard your thoughts on it. I know you've been keeping in tune with it. What do you think?
So I'm actually reaching out to some shareholders of Monmouth to get an idea as to when they bought in and why did they buy in at the time that they did. I want to get a more comprehensive view from the other side, because I can see why they didn't go for the all cash offer, because of tax considerations and so on.
Yeah.
Right, that made sense. So I want to see what value did existing shareholders see. So I saw on Twitter there was someone, I forgot his name, but he mentioned that his fund is a shareholder of Monmouth. So I've kind of reached out to him just to get an idea as to what's happening.
I saw that tweet. I replied to it after you replied, I think. So I was looking for all the equity tweets too. That I'd love to hear what they say. Karan, are you sticking right now?
Yeah, he's frozen for me. Have we lost Karan?
All right, I mean, we're all around the world here. We're in 5 time zones. All right, I think
He's
Karan-
back.
He's back. He's back.
Kind of.
Yeah, sorry.
You cut out for a second there. But so you've reached out to a bunch of people, and I mean, that'd be really cool to get their insight on it too.
Yeah, I want to know what exactly made them buy into it, because clearly what they thought is what Sam Zell thought, and that's why he decided to merge the company.
Yeah.
So, like, we can obviously, just go through the properties, we can look at the value, we can say, oh, this is how much it's worth, but we still wouldn't get as much of an idea as an existing shareholder who's been holding the company for like 3 years now or 5 years. So that's the perspective that I want to get. That's what I want to first find out. So take my time, figure that out, and then I'll probably discuss my view with the company.
I want to see them close the deal and then hear what Sam Zell really thinks about what he's trying to do. Because Karan and I have a hefty suspicion that he's going to be selling a large portion of, or at least some portion. I think maybe the ones that just leased, because the Monmouth has a few newer acquisitions. So, you got a 10, 20-year lease or even more in the case of an industrial property. You'd sell that property right away because your pricing power is limited. So that might be the assets that they try to turn over and add to their cash pile. That would be my initial guess, but until they close, he's not going to be honest about it, or at least he's not going to say much about it, I would think.
I'm learning also more about last mile delivery. So figuring out what sort of properties would make more sense. So that is not something that I know much about right now. So that's what I'm reading up on that. And once I have a better idea about that, I think it'll give me a better idea about what properties, what industrial properties, does it make sense for Monmouth to hold on to, or Equity Commonwealth in this case, to hold on to, and then, what they can possibly sell off. It'll give a better idea, I think, over the next 6 months, as I understand the company better.
Because half that portfolio is FedEx warehouses. So literally half of the rent roll comes from one tenant. So across many properties, yes, but that's a lot of tenant risk. So I'd imagine the first move would be to maybe sell some of those or somehow transition away from just one tenant, because you don't want to have that sort of tenant risk in that size of a portfolio. Anyways,
I think
we should
the
move on
downside
from
protection. Yeah, the downside protection is still there in the company, which is
totally is.
Which is why I'm still in it, which is why I even bought more.
I haven't pulled the trigger on buying more yet. I'm tempted, but industrial is just so expensive right now. But the downside is so limited because 100% rent payments through a pandemic, that's like the one sector of real estate that's done phenomenal, has been distribution, industrial, because everyone's doing e-commerce. No one's doing retail. Where retail loses, typically something like industrial would gain. So,
and as cap rates rise, the price of the assets come down. So then there'll be more distress. Hopefully they'll get into more deals. Makes sense. I mean,
I would think so, but we shall see. It's an interesting one. It definitely unexpected. Here, Karan, someone wants to know about your tax rate being in the UAE. We were talking about this the other day.
30% tax on dividends. Yeah.
What percent?
30% on dividends.
That's pretty hefty. But is that it? Jeez.
0 capital gains tax he pays for anyone that's curious.
That's spicy over in the UAE.
It's going to get me moving over there soon.
Anywhere in the world. I mean, I think if you're Japanese, if I'm not mistaken, you pay no tax, like nothing on dividends, nothing on capital gains, because of the double tax agreement that they have with the US.
Sure. Painted in a different place.
I think, Japan is the only one, if I'm not mistaken. Yeah.
Here's a tricky one. What are the characteristics of a 10-bagger or a 100-bagger? Man, good bro. If we knew that, we'd have all the secret sauce.
Well, Chris Meyer in his book basically tells you need 2 things, which is a lot of growth for a long time and multiple expansion are kind of the 2 ingredients. So the earnings go up. If you want a 100-bagger, I don't know, your earnings go up 50x and the PE ratio goes up 2x, and there's your 100-bagger. So if you can find a business that does that, that's the formula.
That's the
Find
math.
it. It's easier said than done.
Now you
I highly recommend.
You got the math. Now I need the fortune telling is all. So
I highly recommend reading Christopher Meyer's book, 100 Baggers, or Thomas Phelps' 100 to 1 in the stock market, which is pretty much the prequel to Christopher Meyer's book. But there's a few things that he outlines. So things like a coffee can portfolio, never selling the stock, which is easier said than done. High returns on equity is another thing he pushes out. Buying it cheap, so allowing room for multiple expansion, like Tom said. And then earnings per share growth, pairing all those things together. He outlines a lot in the book, but of course it's almost impossible to really know what the next 10 or 100 bagger will be looking like right now. Hopefully there's 5 of them in my portfolio.
And the other thing he said, I forget the exact amount of time, but the average, he studied like 300 100 baggers roughly, and the average period of time for that 100 bagger was approaching 15 or 20 years from memory. So that's what you're looking at as well. Unless you buy GameStop. We haven't done our weekly GameStop segment.
You get a 100 bagger in like a month.
Just find a stock with over 100% short interest.
Just find those, yeah. And then get a meme community involved, and there's your catalyst, and you're good. Here's one for you, Tom. About A2 Milk. You're our A2 Milk man. Is this the next Amex opportunity?
Is there a scandal in A2 Milk?
No, well, there's no fraud that I know of. I guess that's how all fraud starts out. But, I mean, it's a different situation. Like there's, I guess the fraud in Amex is an example of what Phil Town might call an event. So, something that is short-term in nature, which is going to hurt the business over the next 1 to 3 years, for example. And then after that, it's smooth sailing, which is clearly what Warren Buffett thought. So is A2 Milk the same? We talked about this a couple of weeks ago. It's a hard one. I think it's, Amex was probably hard at the time as well. And we'll have to ask Warren, but I'm not sure whether A2 Milk will return to their future growth rates or not. If they do, then it's really cheap right now. And if they don't, then maybe it's not so much. So that's a little bit of a non-answer, but yeah, that's a little bit of a non-answer, but potentially it's one of these classic Phil Town events. Like he gives several examples of these, events style investments that he's made in his podcasts and books. Like he talks about the E. coli, I think it was, scare with Chipotle, where he was able to get back in at $250 a share or something, down from north of 500. He's talked about investing in, I forget the name of the company, but some T-shirt company where there was an Egyptian cotton crisis and commodity prices. Gildan, that's the one. Commodity prices shot up, so earnings were shot for a year, but the CEO was coming out and stating very clearly that other parts of the world will plant cotton because cotton prices are so high for the farmers growing it, and we'll get through this and be a perfectly good business on the other side. So, I think events are a really interesting place to look. Whether A2 Milk is going to be another example we'll use in future is yet to be seen.
I think that leads into this question. And maybe you can comment on this too, Frank, but do you invest in special situations or workouts? Or if so, what's your strategy? So maybe not investing in a business that's super stable right now, but is going through some event. It's kind of related to what we're already talking about.
I think he means like merger arbitrage and stuff. That's what he means by workouts.
Oh,
I think so.
Shit. Well, yeah.
Can you clarify? Cryptic sell?
It's very cryptic what you're saying.
Yeah, I know.
But Frank, you were saying about A2 Milk.
So with A2 Milk, I think a fundamental part of the business has changed. One of their main distribution channels is completely eradicated at this point. So it's whether or not you think they can either fix that or adjust and change that. I don't know enough about the business to know if they can, but that's the main hole in the business. They got rid of some of the management that might have been accused for somewhat fraudulent behavior. They sold out with assuming inside information, but there's been as far as I know, they haven't been charged with anything, have they, Tom?
Not that I'm aware of.
Just random media accusations and things like that. But overall, it's the distribution that's the concern. And if that doesn't get fixed, then there is big problems with the company. If they can pivot away from it or get those channels back up and running, then it's a very cheap stock at the moment.
Yeah, the other part with A2 is a lot of people, I don't know if they're just finding concerns as the stock price goes down to try and explain the stock price going down. But the other thing people are starting to be more concerned about is potential competition, which I think is my personal opinion is that's an overblown concern right now, but again, we'll have to see. Just on workouts, I think that's a term Warren Buffett used to use in his partnership days about liquidating companies. So maybe
Here's Cryptic's clarification. No longer so cryptic.
Oh, there you go.
Corporate events like mergers, restructurings, spin-offs, etc. Like what is mentioned in You Can Be the Stock Market Genius book. So investing in those sorts of companies, I guess Equity Commonwealth would be a sort of example in that they're making a huge acquisition and then they're merging with Monmouth Real Estate.
Yeah, so Monmouth, buying Monmouth at like 19
yeah.
or 18 and waiting for it to go up to 19.5.
Yeah, whatever. That 19.4 is the merger price per common share.
Plus the 18, plus the 0.18 difference. So investing in that would be the workout. Yeah.
Yeah. So
it's a good alternative to cash. I mean.
Yeah, because you have a buyer on the other end essentially, so your downside should be very limited at some certain price, of course. Do your research, but theoretically, if the deal goes through, then yeah. But there is a risk that the deal doesn't go through, of course, and then you're left holding the bag. So you got to be careful with that sort of stuff. You really got to see how certain the deal is to actually go through, if that's your strategy you're going for. But yeah, if there's like a big spread for some reason, it could definitely be worth it for a short-term sort of play, or even long-term if you want to hold on through the merger.
Tom, yeah, go ahead.
Oh, sorry, I'm saying I don't actively look for special situations, but every now and then you hear these opportunities arise that I'm not opposed to investing in those type of things if I understand exactly what's happening. But there's always random like arbitrage type situations that arise. So I think it happened with corporate travel management where they sold shares at a certain price. So there was an offering for shareholders. The stock price was much higher than that. So essentially you could just put cash into it and make money. It almost happened with AFL, the company I hold, Australian Family Lawyers. Similar situation. Although I'm not sure how that ended up. They might have ended up slightly below the selling price they had on that capital, but there's always little arbitrage type situations and special situations that we should take advantage of, but sometimes they're more complex than I would like.
Hamish Hodder. I was just going to say, Hamish Hodder has a good YouTube video on that corporate travel deal. If anyone's interested, I think you did have to be an existing shareholder to take advantage of that from memory. But,
yeah, that's the same with Australian Family Lawyers. You had to be existing shareholder.
Yeah. Sorry, Karan, what were you saying?
Yeah, there was even the Fitbit deal with Google where they decided to acquire the company. That was a great opportunity if someone was looking to do merger arbitrage workout, place for cash. It made like, I think 6-7% risk-free, essentially.
So there's something there. It depends on the deal, obviously, but there's in many cases you're not going to have that opportunity, like Frank and Tom were saying. If it's locked to future shareholders, it's only present shareholders, for example. So you got to know it's, hey, look who showed up.
Hey, there he is.
Have another question here since we're talking about Buffett so much. An article in The Economist this week argues that Buffett should hand over control to Greg Abel now rather than later. Do you agree?
Yeah, Tom, I was hoping you'd take a crack at this one.
No, I think you should just, the system right now is working well, and I think, I've said it in a previous stream, I think, but they've been talking about succession at Berkshire Hathaway since Buffett was 50, and he's, now 40 years on, they're still talking about it. So, did you guys see that Becky Quick got a statement from Warren Buffett confirming that Greg Abel's going to be the next CEO of Buffett died tonight? That's been confirmed. So, it's a hard one. I think if Buffett's still around and his brain is still functioning well, why wouldn't you want him still running the capital allocation decisions at Berkshire? So until that's no longer the case, I think Greg Abel will do a fantastic job, and Ted and Todd will have larger responsibilities for running the stock portfolio at Berkshire. But I think, if Warren's still good to go, then I'll leave him there.
That ain't broke, don't fix it.
Yeah.
That sort of deal.
I think the role of Greg Abel is going to be in the energy sector, obviously, because he's currently the CEO of that and the other businesses. But I think the investment into the transmission section, it's very interesting. Like the way they're planning out the infrastructure, I like the direction. I like the way they're going. So
Hey, this is a completely random aside, but I heard this in a podcast the other day. I think from Chris Bloomstrand. Is that his name? This is completely unrelated to management, but they were talking about the BYD investment at Berkshire, and I didn't realize this, but apparently the BYD investment is within Berkshire Hathaway Energy, which Berkshire Hathaway is actually not 100% shareholder of. Which is kind of an interesting place to put that investment. And I don't entirely know what to think about that, but that was just a random fact I stumbled across a week or two ago.
what did he say about it? What did Chris say about it? Chris Bloomstrand?
He sort of said, it's interesting, not sure what's going on there.
So does Abel manage that decision?
Karan, what was that?
Yeah, Chris Bloomstrand, he really knows the company. He's been a shareholder for 20 years or something, right?
Yeah, correct. Yeah.
So does Greg Abel make that decision with BYD then, or is that still a Buffett investment, or any idea of how that worked, Tom?
Well, I mean, Berkshire own by far and away the majority stake of Berkshire Hathaway Energy, so I would think it would still be with Buffett, and that was sort of a Charlie Munger influenced investment, and I guess Lee Lu before that. So I would think it's still at headquarters, but who knows?
Here's one for you, Brad. Any updates on Alibaba, since I know
Yeah, so
you followed Munger into that one?
So I've been reading Nick Sleep's partnership letters. Fantastic. And one section in there, he talks about why Charlie Munger doesn't talk about his investment ideas. Because as you project out, what your thoughts are about a company, you're also drilling them in, and it makes it harder to change one's mind about things. So the only thing I'm interested in with Alibaba is to hear why it sucks. So that's I'm not going to go into Baba now, but I thought that was an interesting thing I picked up from the letters.
Are you in the 2004 letter? 2004, 2005?
That's 2004, I believe. Yep.
Yeah.
You've read them too, huh, Karan?
I'm reading. I'm
Yep.
still going.
Yep.
The Costco breakdown. Are you going to do that? Are you going to make a video about it?
I'm going to do it, unless one of you beat me to it.
All yours.
Got no competition.
All yours.
Yeah.
Take it. Our niche corner of YouTube.
Yeah.
It's really good though. The way he breaks it down is
I know. It's amazing. Yep.
Most of my views have come from barber videos, so I might steal that idea and get on it right away.
Take it. It's public domain now. We just live streamed it, so no ownership over it.
Well, Hamish Hodder's watching. Hamish Hodder's watching. He might steal the idea.
Hamish, I need one of those Men in Black sticks here. Delete your memory.
Yeah.
Hamish has already left the stream to go make the video, guys. We're not gonna say that.
Here's a good one to wrap up on. I think from our man Jesse. Why others are not investing the way we are with value investing. I mean, we're not all investing in the exact same way. It's kind of a general school.
Just you and Karan. Yeah, only you and Karan.
Yeah. We happen to share a number. But why is value investing a contrarian approach to investing? That's kind of what it's pitched as. Why is it just inherently that way? What is it about it that makes it unattractive for so many people?
I think people don't. I think people are just not interested in it to a large extent. Like people just want a quick, easy way to invest their money and aren't interested in understanding different businesses. But for those that are interested in personal finance and investing, I'm not sure. I think for some reason, still a lot of people struggle to think about stocks as businesses. And for that reason, they, like in the old 1985 Buffett interview, they focus on things like, am I better off buying a stock on a Tuesday or a Thursday, which a businessman would not think about. So I just think for some people, value investing and understanding that it's a business and it should, in theory, have a price that makes sense based on its assets and its cash flows makes sense to some people and maybe doesn't to others. And maybe some people don't like the volatility of running a concentrated portfolio. Those are probably some of the more common reasons I'd put out there.
Even
Go ahead.
So if we're looking at the current market right now, so if you take an academic definition of growth or value, looking as value as a low price to book, for example, or a low PE ratio, which isn't how we typically define it. But growth stocks have outperformed for more so the last 20 years almost. A couple of years where value would outperform there. But people go where the money's going. The returns have been in a more speculative nature of investment, investing in the story and the high growth companies. So a lot of the market, particularly retail investors, gravitate towards that. And it's kind of obvious why they would do that unless they've been really understood the value approach over the even longer time frame that it has outperformed if you're looking back along the last 100 years or so. But there's a lot of ways to make money. Even between the five of us, I don't think any of us follow the exact same strategy. We are fairly different in our approaches, even though we'd all call ourselves value investors, I'm sure. But there's not one way to make money. So even if someone else is doing something different to you, doesn't mean they're wrong and it doesn't mean you're wrong.
That's super well said. Anyone want to add to that? I kind of want to end on that.
It's kind of boring in a way for most people to be a value investor. Like,
Patience.
most people don't get excited like reading an 8K, oh, my company's filed something, let me go.
Yeah, it's true. It is dry.
So,
But you could say that about a lot of types of investing, like in passive index investing, like that's dry too. It's a lot easier though, so maybe it is just the work and the patience that you need to do. Like kind of like
but
what you were
this
saying
requires
earlier,
you
Tom.
to be aggressive and alert when the time comes.
Yeah.
So
Yeah,
go all
it
in
can be
when-
frustrating too, especially like during this period of like rapid growth. You see everyone rising next to you while you're waiting for your one opportunity. Unless you're Quran, you have GameStop in your portfolio. It's like that can be frustrating. Like if there's like a really hot month, and you're patiently looking for something in a particular sector, even, and it's just not there. That can be frustrating, and people aren't patient. So
I think the big difference is just look at ARK Invest versus Berkshire Hathaway over the last, say, month.
yeah,
Last 3 months, in fact.
or Dogecoin.
I mean, yeah. I mean, that's like a whole different thing, right?
Yeah. That's more of a that's a cultural movement. I don't know what that is. I don't know
What's the other one? The cum rocket or something?
You're lucky we're not monetized
Can't
because we would have just
monetize
lost
video
it.
now. Thanks, Frank. We can finally monetize.
Wow.
And by the way, Hamish says he is writing up a plan for
Damn
the
it.
video. So,
Hamish.
all right, I don't know where we can go from there.
I mean, we might as well end on cum rocket, you know? I mean, how are we going to beat that?
The coin.
Yeah, that's-
the coin. Everyone is what we're
Yes,
talking about.
the coin.
Yeah,
coin.
that's a great climax to finish on.
Oh my God, this went off the rails. All right, everyone. We'll see you next week. on that note, no way to spin out of that one. So we will see you all here next week, same time, and whatever time zone you happen to be from. Otherwise, check out the Discord in the description below if you're not already in that. It is growing, and we got lots of good discussions going on in there. So definitely join that. We don't talk about crypto in there, so we talk about the stuff we're good with. And then be sure to smash that like button and subscribe if you haven't already. Catch you guys later.
Peace.
All right.
Bye.